Predicting the future of the property market is a challenging task, especially when there are so many mixed messages and so much conflicting information available. So welcome to this month's Big Picture podcast, where Pete Wargent and I explore the macroeconomic factors that are currently impacting the Australian property markets. As usual, we're going to cover everything from interest rates, inflation, consumer sentiment, and government policies, and we're going to explore how they affect supply and demand, property values and market conditions. And we're going to highlight the factors that we think you should understand. So whether you're a seasoned investor or simply just interested in the health of the property markets, today's show will provide you with some valuable insights and what I'd like to call expert analysis on the big picture. So join Pete and me for the next 30 minutes or so as we explore the big picture.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Over the last couple of years, we've been producing these monthly Big Picture podcasts with Pete Wargent to help you bring our years of perspective as we interpret all that's happening in the economy, not just in Australia, but around the world, and how this is affecting our property markets. But if you would have asked me this time last year, I wouldn't have thought we'd be talking about inflation at a rate of close to 8%. I wouldn't have thought we'd be talking about 9 consecutive interest rate rises, and that the war overseas, which just commenced a year ago, is still raging. And considering the upbeat state of our property markets 12 months ago, I wouldn't have really thought we'd be talking about the effect of low consumer confidence, historically low consumer confidence now. But here we are. Now, regular listeners will know Pete Wargent well, but if you're new to the podcast, well, firstly, welcome. But because I see so many thousands of new listeners every month, I'd like to explain the reason I'm keen to have these regular chats with Pete is not because of his academic credentials as a chartered accountant, chartered secretary, or because he's got a financial planning diploma. I enjoy these chats because of the credible perspective Pete brings on what's happening around the world as an international investor and business person. So welcome, Pete.
Hi, Michael. Great to be on, as always.
Fantastic. And now you're back in Australia. Last time we spoke, you were in the United Kingdom. And as we chat each month about these things, we realise that predicting the future directions of our property markets seems to be even more challenging now than it's been for a long, long time. Pete, there's so many conflicting messages, so much conflicting information out there. Look, on the one hand, we're hearing a lot of people suggesting we're near the bottom of this property cycle, citing factors such as supply and demand, the really strong population growth we're getting, the fact that we're probably past peak inflation. On the other hand, just over the last week or two after the last Reserve Bank interest rate rise, there's a number of commentators suggesting that's going to cripple our property markets. So let's start off with what's happening at the moment. And the Reserve Bank recently came out with its Statement of Monetary Policy suggesting that we're going to have a number of interest rate rises in the plural in their Statement of Monetary Policy, Pete.
Yes, so the macro environment has been very tricky to predict, as you pointed out. And we've had a whole load of things over the past 2 or 3 years that have been just unprecedented. Closure of the economy, closure of the international borders. The Reserve Bank even said, our models don't really work so well in this kind of environment. And a lot of stuff has played out that wouldn't have been predicted a year ago, 2 years ago, and so on. I guess the big ticket item was that inflation was still running hot in the fourth quarter of last year, leading the Reserve Bank to say, well, further increases will be required. So look, but everybody's been adjusting their priors and trying to work out where interest rates are going to peak. I mean, I guess even if you went back a year ago, nobody would have anticipated we'd be here. And yet here we are. So cash rate target today, 3.35%, expecting another increase in March, which would take us to 3.6. And whether we go further, well, that would largely depend on what happens to things like retail sales and the jobs figures. So, but yeah, I mean, if you speak to some analysts, they're expecting the cash rate target to go to 4.1, which would actually be several more increases. So we'll have to wait and see how it plays out.
Sure. So one element of the way the Reserve Bank does things is by raising rates. I guess another is by what the media likes calling jawboning and actually just scaring us a bit. I think a couple of years ago, the Reserve Bank did the opposite when they said that we weren't going to have interest rate rises till 2024 in a way of making people feel comfortable, confident to make decisions during the challenging times of COVID. So it'll be interesting to see, because the Reserve Bank governor currently has come under a lot of pressure recently, hasn't he?
Yeah, of course. Now, a lot of people are being very critical of Governor Lowe in the media, but as the governor pointed out, that was a deliberate strategy, exactly as you said. The idea of making a statement, we don't expect the conditions to be met for interest rate increases until 2024 at the earliest. Well, that was designed to give people confidence to get out there, make investment decisions, start a business, keep spending. Of course, now the boot's on the other foot and interest rates are rising and people are questioning the merits. But as you said, the Reserve Bank only has really one tool it can use to manage inflation and demand in the economy, being interest rates. Hence why jawboning and actually sort of talking about the potential for increases or decreases is another one of the methods that is used. So at the moment, they're talking about multiple or potential further increases being required ahead, but it's actually just data dependent. If the economy starts buckling or rolling over, then we'll be at the peak of the cycle and won't be long before we're talking about rate cuts again. But if inflation persists and sticks around, then the RBA will have no choice but to keep going. So a lot of ink is wasted on predicting where things are going to go over the next month or two. But it will be somewhere between here and there, I guess.
Now, interestingly, the Reserve Bank expects headline inflation to take some time before it reaches its 2 to 3% target band. In fact, probably not until the middle of 2025. So we're still going to have inflation for a while. I guess the question is, have we passed the peak of inflation? And I think most commentators would suggest that's actually the case. So the December quarter figures that came out recently, which were obviously for October, November, December, we're now in February. It was quite a lagging indicator. There's lots of suggestions looking around the world and locally that we're now past the peak of inflation, Pete.
Yeah, so when you think about the drivers of inflation over the past year, I mean, it's largely been driven by the supply shocks that we mentioned previously. There's been a war in the Ukraine, which has put pressure on food and energy prices. And even before that, we had huge supply chain issues driven by the COVID lockdowns all around the world. So I guess probably 3/4 of the inflation that we've seen has actually been due to supply issues, and the demand was the other part of the story. So I think if you look at the sort of preliminary estimates for what inflation might do this quarter, yes, we'll still be in an inflationary environment. Inflation might be 1% for Q1. It might be 1.5%. We'll have to see how the next month or two plays out. But it should be less than what we saw in December. And the headline figure will start to fall from here, which is what we've seen elsewhere. It's already happening in the US, the UK. I think Australia is just about 6 months behind some of those other countries, though, because our lockdowns, as you'll remember, being a Melbourne resident, went on for quite a bit longer than elsewhere in the world. So we'll start to come down the other side in due course. But it might take us a little while to get back to that 2 to 3% range, just as you said.
Well, of course, the Reserve Bank's raising interest rates to slow down our economy, to stop our spending, to slow down inflation. But it's also had the effect of dropping consumer confidence sharply. But not just the interest rate rises, but I guess it's the media, the continual messages about inflation, about maybe a recession. Consumer confidence is now back to around recessionary levels, Pete.
Yeah, it's about as low as we've seen outside of a full-blown recession. So there was a bit of a recovery, but now the interest rate hikes have choked that off. So consumer sentiment is very, very low, just about touching recessionary levels. Business confidence has been somewhat higher for various reasons, as businesses have been able to pass on some of the hikes in prices, and some parts of the economy, businesses have done really well. But consumer sentiment's really low. We just started to see that in the retail figures at the end of last year. There was a big drop in December. And obviously, there's seasonality to take into account. Yeah,
well, there's all those... The big spends we used to have in December were brought forward a bit, weren't they, with Black Friday and Cyber Monday and things like that?
Absolutely, yeah. So, I mean, I guess 1 month one swallow doesn't make a summer, and you shouldn't read too much into 1 month of figures, just the same as with the jobs figures. But it does seem as though probably the retail party is now well and truly over, and we'll start to see that sort of falling away in 2023 as well.
Another factor that's changed in the last little while, the latest employment stats showed there were 11,500 fewer people employed. Unemployment rose a fraction to 3.7%. Participation rate fell a fraction. But overall, things aren't really that bad. The suggestion could be that maybe over January, the figures are a bit larger than normal because people have put it off starting work over the school holidays and over the Christmas holidays.
Yeah, so I guess having been through an unusual 2 or 3 years, a lot of people took the opportunity to get overseas over December and January. Those people have now returned, but I think we may see when the February jobs figures come out that there could be some bounce back. A lot of people were absent in January due to holidays and also some illness still persisting. But I think, you probably, when you look back on it in a year's time, you'll probably see that the unemployment rate roughly bottomed out around July to October last year, around 3.5%. We're at 3.7 now. The RBA sort of thought that we'd be at around 3.8 by the end of the year. Well, we're almost there already on the January numbers. So I think that's one thing that will be watched really closely alongside the retail figures. If the unemployment rate starts to rise, well, that could be the trigger for the Reserve Bank to pause on interest rates. So we've gone from 3.5 or just below to 3.7. So there'll be a lot of people watching the February numbers closely. The other big ones are retail and, of course, the inflation figures.
Sure. One of the things they're not really looking at or seem to be concerned about what it's doing to the property markets. And sure, the property markets started falling, particularly in Sydney and Melbourne last year, 12 months ago, based more on affordability because interest rates hadn't started rising yet. And it depends whose figures you look at, but the property price falls for the annual year, for the year December to December to finishing 22, were nowhere near the crashes that some people predicted. And in fact, it now seems like the rate of decline is reducing, Pete.
It's really interesting. If we'd had this conversation a year ago and somebody had said, well, the cash rate target will go up by 325 basis points by February 2023, we'd have thought, wow, that's going to have some serious impact on confidence and the housing market. But actually, I think CoreLogic has prices down nearly 10% at the capital city level. But some of the other data providers actually quite a lot less in terms of the declines. I think if you look around the country, certainly there's prices down 20 to 30% in some of the coastal markets. So northern New South Wales, if you look at the sort of the Byron, Ballina, Lennox Head, Lismore type markets, well, I mean, prices more or less doubled there through the pandemic. So, a decline of 20 or 30% in some cases, maybe not that unexpected. A little bit the same if you go to the south coast, Bulli and Woonona and places like that. And actually Sunshine Coast, places like Parisian Beach, we've seen prices drop, from the highs. But I think a lot of these are markets that just had a very unusual spike in prices. If you look at, for example, some of the inner city markets, well, they didn't really fully reflect zero interest rates in the first place because a lot of people were moving outwards. So those markets have actually held up much better. So it depends on where you're looking. Some markets like Perth and Adelaide have held up pretty well. Yeah, it's a patchy picture, but it's nowhere near as bad as what we might have expected given the increase in interest rates.
No, you're right. And it's possible that property values may bottom out soon. I believe later this year, interest rates will peak, whether it's another 1, 2 or 3 interest rate rises. And when that happens, the property markets will reset. And I think the discussion really is more about when rather than if this is going to happen. I know I don't think there's any economist who doesn't think inflation is going to peak sometime this year and rates are going to peak sometime this year. And then confidence will come back and the market will pick up. If rates go up too much, it's possible interest rates may have to go down a bit. And there seems to be more confidence in the market. We've noticed at Metropole there's a lot more inquiries. People are just taking it in their stride. They're just accepting the fact that, the interest rates are going to go up a bit more. Sure, a lot of vendors are sitting on the fence at the moment, Pete. So the lack of stock, of good stock, is one of the things underpinning our property markets.
Yeah, well, I suppose that's the follow-on question, isn't it? Why, given the interest rate increases, why haven't prices fallen that much? And in some cases, they haven't fallen at all. I think that's it. I mean, the first order thinking is, interest rates have gone up, not a good time for property, which is partly true. But on the other side of the equation, a lot of vendors have just decided not to sell. So stock levels are extremely tight in some markets. They're way down. I mean, they're 15% below the 5-year average. But if you went back to, say, 2011, there was probably almost double the amount of stock nationwide that there is now. So that's one factor. I think historically, people have seen that when interest rates start to fall, they tend to cut quickly and hard. And I think some people are probably waiting for some easing of interest rates at some point around the corner. But I think the other thing is, I mean, what's the alternative? Are you going to rent in the current market? I mean, it's not very. You've got population growth running at about 500,000 on my estimates. There's nothing on the market for rent. So I think there's a few other factors that have just held markets up in much better nick than they might otherwise have been. And I think there's an awful lot of people just sitting on the sidelines waiting for that confirmation that interest rates have peaked.
Well, we've got to look at a number of different metrics. So we keep a track of asking prices, and looking at Louis Christopher from SQM Research's figures, and also Andrew Wilson, who checks asking prices, which are a leading indicator. It shows what's ahead. They've remained flat and in some cases rising. They're not falling anymore. The year started pretty strongly with auction clearance rates, which again is a good indication of how buyers are feeling on the ground. And vendor metrics are pretty firm. Days on market, they're not taking long to sell. Vendor discounting is on the low side. So a number of things are suggesting that the property market's looking for a floor. I don't think it's reached it yet because buyers are still out there, lack of stock, but yields are increasing. I think one of the things that's going to help underpin it is the very strong population growth, as you said, bigger numbers than many others are suggesting, and the lack of new stock. We just can't build new apartments, new complexes, and even new houses at the moment because they're too expensive for what the market's prepared to pay.
Yeah, the supply issue is really interesting because if you actually looked at the number of dwellings under construction last year, it was a record high. So it was the home builder stimulus or housing starts all around the country. It wasn't just a capital city thing. It was regional. It was all over the place. I think, though, there was a number of issues. Couldn't get access to materials in many cases. There was problems getting access to trades and services. Sort of building approvals have fallen away this year. New home sales have halved from a year ago. So even though there's a lot of supply still notionally in the pipeline, they're just not getting completed at a fast enough pace at the moment. I think if you look further ahead, well, there's going to be a supply crunch. Just looking at those new home sales, they've literally been split in half from a year ago, and they're way down from their highs. So building approvals will follow lower. Yeah, it's going to be a real challenge. I mean, building approvals, they're always noisy month on month. But if you look over the past year, we're already at 24-month lows. And that's just at a time when population growth is absolutely rocketing back. It's, we're going to see the highest population growth we've ever seen this year. And there's not really going to be enough supply keeping pace. And that's only going to get accentuated as we go into 2024. So I think that's one of the big questions is where's the supply going to come from?
Well, despite the building approvals, that doesn't mean they actually come out of the ground, especially the big towers, which are just not financially viable at the moment. And that's created the rental crisis that we've both just been hinting at. This year commenced with record high capital city rents throughout Australia. Vacancy rates are less than 1% almost everywhere. I don't ever remember that happening before. There's really no properties for lease. We manage over $2 billion worth of assets for clients at Metropole in our property management divisions. I don't think the only other time we've had as few properties for lease is when we first started off and we hardly had any properties at all for lease. And we're getting applications without people even seeing the properties. They're so desperate. Now, we don't accept those. People have to go and have a look at it, but there is a level of desperation out there, and it depends whose figures you look at. But according to Dr. Andrew Wilson, the apartment market in Sydney had almost 25% increase in rents, 22% increase in Melbourne house rents. It's creating all those stories that are ending up in the media and on a current affair. But it's a concern because people's household budgets are hurting.
Yes, I think one of the things that's slightly different from earlier cycles, there's far more properties on short stay portals like Airbnb and some of the other outlets now. But putting that to one side, yes, I mean, I've had a couple of properties come up for lease in Sydney. I've got some properties there, and I mean, the applications just flooding in, even with higher rents. People are. I think if you've got quality property, then the demand is just through the roof. I think it's. I think SQM runs a parallel series on asking rents. Well, they're up 30% in Sydney over the year. Brisbane and Melbourne up 25%. That's houses, apartments, everything. Now, the way supply and demand tends to work, if rents go too high, people will start to look at other options. Can I share? Can I live with parents for longer? And things do eventually balance themselves out. But at the moment, it's just going one way and rents are rocketing. And this is just one of the things that is underpinning, particularly the lower end of the market. I think first home buyers are thinking, well, what the heck, I can't be living with 30% rent increases. I may as well get on the ladder. So the bottom end of the market's held up better. Even in the middle section of the market, if you've got a family-friendly home that's in good condition, doesn't need a renovation, there's still plenty of competition for good quality stock. The market is patchy, and certainly the top end of the market prices have come right off, but it's not by no means the doom and gloom picture that you would assume from the interest rate increases and certainly from the media headlines.
Unfortunately, some investors are thinking in the short term and selling up. Interestingly, we ran a property investment sentiment survey every year at the end of last year. A third of those who were surveyed, who were property investors, said they sold a property in the previous year, and Pippa's survey was very similar. In the last few weeks, realestate.com showed that 25% of the properties currently for sale were in the rental market, in the rental pool before. And I guess they can do that, Pete, because they can see with their statistics that 24 Smith Street a year or two ago was up for rent and now it's for sale. So it's a very large percentage, rather than normally about 10% of those currently for sale were previously investment properties. So I understand why some investors are wanting to get out there, seeing interest rates go up, their holding costs are going up, and others are worried about the regulation, the challenges of being a landlord. But in my mind, that's short-sighted because, yes, each boom leads to a downturn as we're experiencing, but each downturn also sows the seeds for the next upturn.
Yes, I think regulation is a part of it. I think you often find when there's a slowdown in the economy, the first things to go are often holiday homes. Sometimes if people have had an underperforming rental, they just think, well, I'm just going to offload this and cut my losses. But for people who are thinking strategically, I think, well, as we've always said on this podcast, property tends to work well as a longer term investment. And if you invest for the long term, you're going to have recessions, periods when interest rates are going up, periods when they're going down. There'll be periods when vacancies are high and then other times when they're low. And this is all part of the cycles of being a long-term investor. Even inflation, people are saying, oh, this is terrible, 8% inflation. But for somebody who has debt, inflation effectively inflating away the value of the debt at 8% is not actually a bad thing over the long run. So I think there's certainly been some landlords selling up, but if you're a portfolio investor for the long term and you're focused on quality, not quantity, it's probably not the right time to be thinking of selling.
Definitely. I know you follow Morgan Housel as I do, and he's put it very well. It's actually a fee for being in the market. It's not a fine for being in the market. Some people are seeing, oh, what a pain, what a penalty. But that's just the cost of doing business. Now, one of the things that's been talked about a bit is that there's going to be a mortgage cliff. That cliff, another cliff. Remember all those others that we never ended up having? But this is the fixed rate cliff where people who borrowed a year or more like 2 or 3 years ago at very low interest rates, their fixed rate loans are now going to come out into variable rates and paying at a much higher rate moving forward. And there's no doubt a lot of this is happening, but I think many smart mortgage brokers are protecting their clients. When you look at the refinancing figures currently, Pete, people are getting ahead of the game.
Well, competition between lenders is really hot, so you definitely should shop around. The average mortgage rate is only up about 2.6% versus the increase in the cash rate targets. That tells you two things. Firstly, there's still some fixed rate mortgages that haven't reset yet. But secondly, people are shopping around, just as you said, and it's a really good time to phone up your bank and ask for a better rate, because for 10 minutes work, you can easily see 50 basis points or even 100 basis points slashed off your mortgage rate. The retention teams are very keen to keep business at the moment. So, yeah, I think as you mentioned, you remember the US fiscal cliff years ago, and then there was the interest-only cliff, and there was this cliff and that cliff. Most often what you find, I mean, these are what they used to call in military circles, they're sort of known knowns. Often the big risks to an economy is when there's a totally unforeseen risk or a black swan event that just broadsides the economy. When everybody knows about something and we've been talking about it for months and it's in the media, well, there's a Sydney commentator and fund manager, James Whelan, he calls it the theory of thing. When everyone knows about this thing, then solutions are found, people shop around for mortgage rates, banks get on the front foot, offer extended loan terms or whatever, and the thing no longer is a thing, exactly as a result of it being flagged so much. So, look, it's going to definitely have an impact on mortgage repayments. It will be felt in things like falling retail sales this year, but it doesn't necessarily follow that we'll see a big lift in defaults or anything like that. Currently, delinquencies are at record lows, so of course they're going to rise. But we've got full employment. We've got the lowest rental vacancies in history. Rents are going up 25, 30%. So there's not as many stressed owners as might be implied. Obviously, if interest rates keep going up, then at some point, some people are going to break.
Now, just to finish off our chat today, you're a global investor and you've just come back from overseas and from Europe. I think there's lots happening in the world at the moment. What's your view of our global economy?
Well, Europe is interesting. If you went back 3 months ago, there was, people were just assuming there would be this big recession. The UK government being one example, well, they got on the front foot. They gave houses or households effectively discounts for energy and electricity bills, because it had been assumed that there'd be this enormous spike in household energy costs due to the Ukraine war. As it transpired, although we had one cold week at the start of winter, it's been the mildest winter that, I don't know about on record, but certainly in recent memory. That whole issue basically hasn't completely gone away, but the big spike in people's household expenditure just didn't happen. In some cases, people were better off, paradoxically. So it looks like the UK may well dodge recession, the Eurozone possibly the same. So I think you talk about black swan events and unexpected things. Well, there was just a really mild winter in Europe, and that's really helped. Obviously, some challenges still on the horizon. The Bank of England is getting close to pausing on interest rates. So, one of the things that really strikes me when I return to Australia is just how lucky we are. I think, look at the challenges facing Europe. There's a lot of tensions, not just the war. There's all kinds of issues around refugees and migrants, and Britain sort of ducking out of the Eurozone. So I think, Australia, there's going to be a big global war for talent over the next decade. There'll be countries like Australia, New Zealand, Canada, UK, US. They'll be right at the top of the list competing for talent. International students is a big one. I just saw a week or two ago an edict from China saying no more online degrees to be accepted. So that's 50,000 students on their way back from China. So I think, Australia, we've had our own challenges through the years, but relatively speaking, we've been very lucky and we're pretty well placed.
I guess in summary, we both see some short-term challenges, some headwinds to our economies, to our property markets for interest rates, but being big picture, long-term thinkers, I think we're both optimistic about the long term. Would that be a fair assessment?
Absolutely. I think if you look at, this is the big picture podcast, right? So, if you think out to the middle of the century, Australia is expected to see a population of around, say, 36 million versus 26 million today. It's a huge increase. People like to do these comparisons between global housing markets. Well, I've got a brother who lives in South Korea, that their population is falling and is expected to halve over the coming decades. Japan has got the same challenges. Australia's in a very different situation demographically. We're running population growth at about 500,000 at the moment, record highs. I think the other thing is, we talked about the role of inflation. Well, if you think about a 30-year investment, let's say you take out a 500k mortgage today, well, if incomes rise at, let's say, even if they rise at 3 or 4%, that will feel like 150 or 200k in 30 years' time. So the debt gets inflated away. Capital growth tends to be consistently strong in those sort of landlocked capital city suburbs that you always talk about, a metropole. So yeah, of course, there's headwinds. This is the cost of the lockdowns. But I think if you take a bigger picture view, Australia's future is very bright.
Well, thank you. I love having our big picture podcasts. Look forward to having a chat with you again in a month's time, Pete. Now, if people want to find out more about you and keep contact with you, in particular, get your daily blog, because I enjoy reading it. You have all the graphs and charts there. How do they get in contact with you, Pete?
Oh, I'm pretty easy to find online. Pete Wargent Blogspot is my daily blog, or you can usually find me on Twitter or other parts of the internet. So pretty easy to find.
I'll leave a link to both of those. Yes, you have a lot of information on Twitter. Now, I know some of it's about sport, but there's also lots of great property information on your Twitter feed, and you retweet other people's clever things as well. So you're a good curator of news as well as a commentator. Catch up with you again soon, Pete. Thank you.
Pleasure. Thanks, Michael.
I hope you enjoyed my chat with Pete Wargent. As you can see, there are so many pieces to the property puzzle, and that's why once a month Pete and I get together to explore the macroeconomic factors, the big picture as we call it. And I guess you can tell that we believe later this year, when interest rates peak, there's going to be a reset and the market's going to move on. But it's not going to boom. Now, I know everybody wants to hear that the property market's going to have double-digit growth, or they're going to look for the next hotspot which is going to boom. And I know some people want to beat the banks and buy property with no money down. But in reality, for the vast majority of us, property investment should be boring. If you're looking for excitement in your investment, if you look for excitement in your life, go bungee jumping, go trail bike riding. You'll remember Warren Buffett's famous quote, "Somebody's sitting in the shade today because somebody planted a tree a long time ago." Planting a tree is a long-term bet. Solid investment strategy should be as interesting as Warren Buffett's analogy of a tree, just watching it slowly grow. You don't plant a tree today and expect shade tomorrow. But if you plant the right seeds in the right conditions, sooner or later, time will work its magic and you'll have a tree. And if the tree isn't growing fast enough, digging it up and moving it rarely is the solution. And it's much the same with investing. You really can't find a quick fix or get-rich-quick scheme in this market, but this is the right time to plan and to do and to get ready for the next stage of the cycle. And that's why at Metropole, even before we talk about your next property, we start by building a customised strategic property plan. And when you chat with one of our property strategists, you're going to find their focus isn't just on the next property, even though that's probably what you're interested in. You see, we see it as our responsibility to look further into the future on your behalf and help you find the type of property that's going to set you up for the next property and the next property. And our strategic frameworks have been fine-tuned over 5 decades, and we know how to help you prepare for the property market reset that is surely going to happen this year. So if this is the type of information you're looking for, go to metropole.com.au. I'll leave a link in the show notes and arrange an obligation-free clarity consultation with one of our property strategists to explore your options.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to ask you, what is success? Because this podcast is more than just about property investment. I mentioned that it's about success, property investment, money. And if you're like me, you're interested in learning about success. You're interested about reading about successful people. I enjoy reading about their habits, their philosophies, their behaviour, and the influences of those people who've actually already achieved great things. Not only do I find it motivating, but understanding how and why successful people do what they do, I pick up tools, I pick up ideas how I can improve my own life. So back to what I asked initially, what is success? Well, as I researched it over the years, I came to realise that success has got many different definitions, depending upon who you ask. The dictionary definition of success is the accomplishment of a goal, the desired result of an attempt, or that one succeeds. Now, I know many people think success is all about money, fame and power, but the many stories of unfulfilled lives or the burnout amongst so-called successful people shows, however, that success isn't solely about achieving possessions or attaining goals. In my mind, success is a life that's much more than money and power. It's defined by your actions about how you live your life. So what is needed for you to succeed in life? And I've come to the conclusion there are 6 essential aspects to happiness and a successful life. As I work through these, have a think about them. How do they fit in with you and with your goals? And do you agree with me that these are the essential aspects of happiness and success? Now, the first one's physical health. You need to be physically healthy to have the energy to engage in life. If you don't have your health, you can't function. You can't be truly successful, can you? The second one is mental fitness. You need to be continuously engaging your mind, learning and growing, experiencing new ideas, getting better, pursuing mastery, and putting your ideas to work to accomplish your goals. So, for me to be truly wealthy, you need physical health, but you also need mental fitness and wanting to keep growing. You also need emotional health. You need to be self-aware emotionally. You need to feel good about yourself. You need to have a positive self-image. If you're depressed to the point where you can't function, you can't be successful. Now, I recognise that for a lot of people, this is out of their control. So, again, I'm not giving you any medical advice, but I'm suggesting that if you are having emotional or mental health problems, don't be embarrassed. Seek help. Ask for help. We're working through the 6 essential aspects to happiness and success in life: physical health, mental fitness, emotional health, and I also want to suggest social health is important. You need positive relationships in your life and people that love you and support you. You've got to have friends and loved ones you can trust that make you a better person, that inspire you to be better. Basically, humans are social. If you don't have people who care about you and that you care about, you can't be successful, can you? The 5th element you need to be successful, well, in my mind anyway, is purpose, meaning, spiritual health. You can make a positive impact in other people's lives. You can give meaning and purpose to your work, to your daily life. This keeps you focused and inspires you to overcome the day-to-day struggles and setbacks that are part of everybody's life. Every day I get a couple of emails from people who listen to my podcast, who read my blogs, who read my books, who tell me about their successes and how I've inspired them. That makes my day. That gives me the purpose to continue producing these podcasts. And then the 6th element that you need for success is material wealth. Of course you do. There's the basic levels of food and shelter and clothing that all people need, and that's paid for through money. If you're poor, if you're too poor, if you've got too much stress, struggling financially, you can't be successful. So you can function and be happy in the short term without all of these elements, but in the long term, if you're missing one of them, it's unsustainable and you're probably going to become unhappy. So, of course, something's going to have to change in your life for you to become more successful. Emotions are how your subconscious communicates with you. They're one of the reasons humans are so resilient. So if you're unhappy, it's probably your body's way of telling you something's wrong with you or your life. It's probably telling you to do something about it. So as I said, I've come to the conclusion that success is the drive for long-term sustainable happiness. In the short term, you can find happiness in all sorts of things: Instagram likes, money, partying, small wins, YouTube, TV, alcohol, shopping, movies. But in the long term, if you don't have those 6 elements, those 6 essentials that I talked to you about a second ago, you're not going to feel happy or successful. Of course, don't compare yourself to others. Don't worry about what others say or do. Only you can know if you're truly successful or not, and this is only the case if you're on the path to happiness over the long term. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?